Okay, so today we're joined by Chris Downe, who is the co-founder and operations director of Ethira Property. So do you want to give a little introduction to who Ethira Property are?
Yeah, so we are a independent data-led property investment advisory firm. So sort of similar to what Cardinal do. We take a very in-depth review of clients' past information, current goals and objectives, and from that we put together strategies and plans to help them achieve their financial goals.
Perfect. Yeah, although we're competitors, I guess we are sort of quite aligned in the way we don't want to consider ourselves agents.
Yeah, exactly.
We want to consider ourselves consultants who use data, who use financial breakdowns in order to actually provide sort of independent advice.
Yeah, and we've both been in the market for coming on to 20 years, probably almost now. So it's been a long time that I've been working in property. We first worked together a long time ago.
Yeah, nearly 10 years ago now.
And then I've gone slightly different routes to get to the same position, but both now fortunate to be in control of our companies and what we do. So I think we're going to talk through the budget.
Yeah, so we're going to go a little bit, the budget that was released today, or maybe yesterday by the time we upload it. But just go through a few key points. I mean, to be honest, before the budget happens, there's always a lot of speculation about what's going to go on and a little bit of doom mongering a lot of the time. But there was only a few points that really related to property investors or landlords in general. And a few of them related to a very small proportion of the general landlord population as well. So the first one, I guess, would be the mansion tax, they call it. Mm-hmm. So the increase in the council tax or the surcharge for properties worth over 2 million and then rising to properties over 5 million. So what are the figures of that again?
Yeah, so over 2, it's looking at about £2,500 of tax. There's certain bands within that, but it caps out at £7,500 bill per annum, and I think that's for properties over 7 million. And I think in terms of how it affects investors, it's probably pretty light on this one. In reality, if you're looking to buy a property that's over £2 million, you're in particular areas where you're going to live anyway. It's sort of an unavoidable tax. We generally, and I'm sure you're the same on this, don't recommend anyone invests at anything over probably about 500,000 unless they really want to, just because your stamp duty costs are so prohibitive at the moment, your financing costs are so prohibitive. I think an interesting thing on this one that I was sort of thinking about on the way over here is that there is potentially something to be said about clients that have assets that are worth over £2 million that are debt-free, potentially taking some of that debt and using it for an investment to cover any increase in costs if that cost is going to be hurtful to their income. If you're cash rich but income poor, there's potentially more incentive now to use equity that's in property.
I've seen a few people talk about the sort of demand for those properties, and to be honest, if you're affording a £2.5 million or £5 million property, will a £2,500 surcharge per annum lower the demand for those properties? Probably not.
Yeah, that's a good point.
But as you mentioned, for property investors, we tend to look at sort of 500k as the higher end. Properties at 2 mil, 5 mil was usually sort of central London properties. And then when we're looking at things like yield, they're probably the lowest yielding properties in the entire country. And in terms of capital growth, they've seen their growth, the £2.5 million properties. The only areas in the UK that really dropping in value are these kind of luxury properties. So we wouldn't really say it affects property investors as such. Maybe residential, a little bit.
And you can't really see people, I think some people have said, if a tax comes on high value properties, then there'll be people looking to sell and move out of the area. But I think realistically, if you're paying, and I can't think of the numbers at the moment, but the stamp duty is probably upwards of £150,000 on those properties. If you're spending an extra £2,500 a year on that, most people aren't going to be affected by that. They're already living in those areas. So I don't think it really has that.
Yeah, that's like impact. 60 years it would have to go on for to
make it equivalent.
Be the equivalent of stamp duty. I guess for some people it might affect the sort of properties they look at. Maybe they try to get just below 2 million, but from an investment perspective, it's fairly
I'm also really interested, because obviously we were just doing this just after the budget. I'm really interested to see how they actually value those, because value is so subjective. I don't know how they're going to work out, if they're going to send surveyors around to every single property worth more than 2 million in the UK to work out value. I think that's interesting. I don't know how.
Because a lot of the controversy around the council tax was about how the valuations from the 90s and things like that. So I'm not too sure whether it's going to...
They'll probably spend more doing the valuations than they will
exactly.
from the income from it.
So
let's see.
We'll see about that one. Another factor that is probably more relevant now, or definitely more relevant, is there's some increased taxes that have happened. So first one would be the income on rental, rental income, rising by, I believe, 2%. So the basic rate's now going up to 22%, high rate 42%, additional rate 47%. So what are your thoughts on that for investors?
I think it's an interesting one. It's another push from the government for people really to think further forward about how they're investing and be more strategic about the investments that they do, which we've been speaking to clients about for years and years. But I think if you're a legacy landlord, if you've got properties that you've had for a long number of years, that you've bought as a home, moved out, kept, this is going to affect you quite significantly. But in reality, the most strategic way to invest has always been through some sort of structure, like a limited company or a structure like that anyway. And this is just purely income tax on properties that are in your personal name. We'll get onto the taxes that have changed a little bit, but I think this is the biggest change, as you said. I think it's probably not that bad a change. I think it means that people need to revisit how they're investing and get an idea in terms of what the best structures are. But
it's pushing more of that sort of corporate landlord again, because it's not affecting the corporation tax, which is how limited companies are taxed on the rental income. So we might see an increase in that happening, although, I mean, with our clients, pretty much 100% of them are already buying limited companies. So I don't see it changing too much in that. One factor that people mention is whenever there's increased taxes for things like rental or profits, it's then sometimes pushed onto the consumer, or in this case, the tenant.
And I think it will be. I think there's going to be two things that happen. There's either going to be increased rents for tenants, although obviously there's the rental reform bill which is coming in, which has some mitigation around that. But the second one is a lot of those legacy landlords that used to own property in their personal name are probably going to look at selling if they're at the limit anyway. I don't think it'll affect house prices too much, but it will affect the availability of rental stock. So those people that are within a corporate structure and can afford to keep it going and have structured in the right way are more than likely going to see rents increasing, because there's just going to be less properties available to rent as this goes on, I think. Yeah,
that makes sense. Okay, so another tax that we'll go on to now, seeing as we're on the topic, that affects the sort of the landlord or the more corporate landlord, is the dividends tax. So the dividends tax is now increasing by 2% as well now. 2%
as well,
And often people who have their properties in limited companies, they'll pay themselves a bit of dividends. So that's lowering again. I think
this is an interesting one. I think dividend tax has been low for a long time, 8% or 32% roughly. It will have an impact for those landlords that have large portfolios that have been paying themselves minimum salary and dividends. I think what's interesting is a lot of the time when we speak to clients about property investment, it's usually long term. So it's about people investing for a pension, or investing so they can stop work or retire, or investing so they've got a portfolio for the future. The change doesn't necessarily affect, like you say, corporation tax has remained as it was, which means that if people are planning for retirement, they're earning a high income now, they put their investments in a company, the taxes that they pay on corporation tax in the company doesn't change. And then when they stop work in the future, if they pay themselves a salary from the company, that salary tax is the same as it used to be. It's only if they pay themselves dividends then on top.
And another thing as well is that often people who accumulate sort of the net rent in a property, they'll accumulate that until they maybe can afford another property, and in which case they're not taking out as dividends. They might loan it to another company to buy a property, or they'll use it as a deposit. So in that sense, it doesn't really affect those kind of investors.
I think it's always been, the plan is companies are an efficient structure if you're doing something for the longer term. To be honest, give it another 10 years and the taxes might all be different again. But, this is a good way to start planning.
Yeah, I mean, some of these, I'm not sure exactly which ones, but some of these are going into effect April 2028.
Yeah.
So we've got
time to go.
How long is that? 2.5 years. Yeah. Exactly. Yeah. So it's going to change many, many times before that, probably.
It changes, yeah.
And even then, there's the next general election in 29. So it might last a year and then something changes.
Yeah.
I
think, just on that, I think that's a really good point, because we've seen definitely in the last couple of weeks or months, clients been really nervous about the budget and wanting to hold off and see what happens.
Yeah.
There's been a number of really big budgets that we've had whilst we've been working in property, and every time everyone's been scared about it, and every time it hasn't really had that much of an impact. This one's fairly light in terms of the changes. It'll probably just keep on going as it has been going. The biggest change that we saw happen was Liz Truss, and the changes more of a knock-on on the financial markets, but even that hasn't really played on the property market.
And I mean, these budgets are nowhere near as they don't have as much effect as like more macroeconomic stuff or like global things, such as Brexit was obviously domestic, but things like that. Or
you're right, if you're investing in the right location, the right market, it doesn't matter what's really happening.
Yeah, it was a video that you released just a few days ago. Is one of the fundamental parts of property investment is just the simple economics of demand and supply.
Yeah.
So there might be 1%, 2% dividends tax or rental income increasing by 2%. But if you're investing in an area that has, a huge lack of supply and lots of people moving into the area or lots of students staying in the areas, lots of young professionals, I don't think 2% increase is going to...
Not going to do a huge amount, is it?
It's not going to mitigate that. Especially for these higher yielding areas, maybe... in London, where it's really low yielding, you're talking net yields of, sometimes negative, but gross yields of maybe 2%, 3%, 4%. If you're right on the cusp of whether it's even worth it from a cash flow perspective, maybe these marginal increases might deter you or might make you reinvest in other locations.
I think that's the thing, isn't it?
But, I think for us, our clients, we want to be achieving at least a 6% rental yield, in which case that's 6% of the property price. So shouldn't have too much of an impact.
Yeah.
Certainly.